Good morning or good afternoon, depending on what time it is for you. I would like to welcome each of you to our webinar series. In the email blast you received, you're presented with 4 different presentation options. I encourage you to view each one of them as they will provide you with some great insight regarding changes brought about by the CARES Act and other recent tax legislation. I only wish this was being presented at a better time for all of us. I do hope that each of you and your families are safe and healthy. My name is Ray Gallagher, and I'm a tax partner at Levine, Lofgren, Morrison, Engelberg. This is one of 4 presentations to help you navigate through the changes and new legislation that revolves around the CARES Act. We have divided into 3 technical presentations and an economic overview presentation by Bob Lofgren. One final note before we get started. Keep in mind, new legislation and additional guidance is occurring almost daily. Some of the material covered in our presentations may have been changed or clarified since we produced these webinars. We're here to help you navigate through all of this, so please feel free to reach out to your LEMI contact for further clarification and assistance. Now on with the webinar. For this webinar on the individual changes affecting us, we have Aaron Carlson and Victor Shalonsky. Aaron is a tax manager with our firm, specializing in estates, gifts, and trusts. She received her bachelor's degree from UC Santa Barbara, go Gauchos, her Juris Doctor degree from Pepperdine School of Law, and her LLM in tax from Boston University. She has been practicing for over 13 years, obviously, smart girl. In her personal time, she loves cooking, jogging, and spending time with her 6-year-old son, as well as her 15-year-old dog. And that's 105 years, dog years. Victor is the firm's tax director. He has over 13 years of experience providing income and estate tax planning services to high net worth individuals and closely held businesses. He also has extensive experience with complex real estate matters. Victor is a member of the American Institute of CPAs, the Cal Society of CPAs, the San Diego North County Estate Planning Council, and Provisors. Victor is also involved in the local community by volunteering his time as CFO and board member of Civic Coffee, and also as finance committee member of the San Diego Jewish Community Center. A frequent lecturer, Victor has presented to a number of accounting groups as well as the San Diego and American Bar Associations. He has also published numerous income and estate tax planning articles. Victor received his bachelor degree in accounting, not recently, he's been around a while. Victor received his bachelor degree in accounting, finance, and management from Loyola Marymount University, and holds a master's in taxation from California State University, Northridge. Prior to joining Levine, Lofgren, Morrison, Engelberg, Victor was a senior tax manager at Moss Adams. Please enjoy the presentation.
Hi, my name is Aaron Carlson, and I'm going to discuss the CARES impact on individuals. The IRS postponed the due date for both filing a return and for making income tax payments due from April 15, 2020 to July 15, 2020. The postponement is automatic. No extension forms need to be filed. This extends the filing deadline for gift tax returns and Form 114, also known as the FBAR, as well. Payments that may be postponed are limited to federal income tax payments in respect of a taxpayer's 2019 taxable year and federal estimated income tax payments due on April 15, 2020 for a taxpayer's 2020 taxable year. Most states which impose tax on wage income have extended filing and repayment deadlines. However, there are a handful of states that have yet to extend. Eligible individuals are allowed a credit of $1,200 or $2,400 for joint filers, plus $500 for each qualifying child for the first taxable year beginning in 2020. A qualifying child is any dependent under the age of 17. There is no limit on the number of qualifying children. An eligible individual is any individual who has a Social Security number and who is not a non-resident alien or an individual who can be claimed as a dependent on another taxpayer's return. The amount of allowable credit is phased out as income reaches certain thresholds. This slide illustrates the phase-out threshold for the various types of individual filers. For the mechanics of the phase-out, the amount is reduced by 5% for each $100 that the eligible individual's adjusted gross income exceeds $75,000 for all filers other than joint filers and head of household. For head of household, the amount is $112,500, and for joint filers, the amount is $150,000. The credit phases out entirely at $99,000 for single individuals and $198,000 for joint filers. In general, the credit will be based on a taxpayer's 2020 taxable income, but since that is unknown for most taxpayers, the checks can tentatively be issued based on the taxable income for tax years 2019 or 2018. The stimulus checks are generally not taxable income for federal or California purposes and are instead treated as an advance of the credit the taxpayer will receive when filing their 2020 tax return. When the 2020 returns are prepared in 2021, taxpayers will recalculate the amount of their credit based on their 2020 information. If there is a change and the taxpayer would now be entitled to more credit, they will receive a credit for the difference. It is still unknown what will happen if the credit ends up being less when recalculated on the 2020 return. The CARES Act does not explicitly require income recognition on any excess credit, but future regulations may address this issue. The CARES Act included a few updates to other areas impacting individuals as well. Charitable contributions of cash are now deductible up to 100% of your adjusted gross income. They are no longer limited to the 60% adjusted gross income limit. There has been no change to the limit on non-cash contributions. For those individuals who do not itemize deductions, they will be entitled to an above-the-line deduction of up to $300 for qualified charitable contributions. Such contributions include cash contributions to a qualified tax-exempt organization. This does not include contributions to private foundations or donor-advised funds. Individuals may find it difficult to make student loan payments at this time. The CARES Act includes an option for employers to provide assistance. Employers are allowed to provide a limited student loan repayment benefit of $5,250 to their employees on a tax-free basis through the end of this year. This amount covers both repayments of student loans and educational expense assistance. As COVID-19 continues to grow in impact, certain individuals may find it difficult to pay for necessities and other expenses. If it is deemed a qualified disaster, there are additional options for employers to provide tax-free assistance. Amounts paid by an employer to an individual as a qualified disaster relief payment will not be included in taxable income. Such payments include any amount to reimburse or pay reasonable and necessary personal, family, living, or funeral expenses incurred as a result of a qualified disaster. A qualified disaster relief payment must be made to or for the benefit of an individual, but only to the extent any expense compensated by the payment is not otherwise compensated for by insurance or some other reimbursement. Unemployment insurance provisions now include an additional $600 per week payment to each recipient for up to 6 months and extend unemployment insurance benefits to self-employed workers, independent contractors, and those with limited work history. This benefit is taxable for federal purposes, but is not taxable in California. Lastly, the CARES Act provided for some updates with regard to health insurance. Reimbursements for medicine through an account-based plan may be made without a prescription. Also, the Secretary of Labor and the Secretary of the Treasury are instructed to require group health plans and health insurance issuers offering group or individual health insurance to cover, without cost sharing, any qualifying coronavirus preventative service. Now, Victor is going to discuss the impact of the CARES Act on individual retirement plans.
Thank you, Aaron. Let's talk about how the CARES Act impacts retirement plans. Firstly, there's no early distribution penalty up to $100,000 if it's a coronavirus related distribution. That is a technical term for any distribution made in the current year and meets one of two criteria. Either the taxpayer, spouse, or the dependent is diagnosed with SARS or COVID 19. Alternatively, the taxpayer experiences adverse financial consequences as a result of the virus. Now, the plan administrator may rely on the employee's basically certification that they meet this criteria. There's no doctor's note that's needed or anything like that, as long as the employer allows for that. California does conform to this specific provision. All the rest of the presentation, as of right now, California does not seem to conform to it. We're still waiting on guidance from them on that. Furthermore, distributions related to the coronavirus-related distributions are essentially prorated over a three-year period, 2020, 2021, and 2022. Meaning, if the taxpayer received a $90,000 distribution, then $30,000 would be recognized as income in 2020, $30,000 in 2021, and $30,000 in 2022. Alternatively, the taxpayer could elect the entire $90,000 in the current tax year. This is where tax planning becomes vital, figuring out which will get a taxpayer to a better outcome, whether it's all to elect it all in 1 year or to spread it out over 3 years. Furthermore, the taxpayer has 3 years to recontribute the funds back into the retirement plan. So it essentially increases the contribution limit for 3 years. And thereby a taxpayer could essentially avoid recognizing any income from the distribution. And again, as I mentioned, this, as of right now, California does not conform to this provision. So we're still waiting on guidance on that front. Let's look at an example of a scenario in which an individual with $100,000 in a retirement plan decides to take out a distribution. In scenario 2, the taxpayer takes out $50,000. In scenario 3, the taxpayer takes out $65,000, $50,000 of which is used to help the taxpayer with cash flow needs, and $15,000 to pay the tax on that. Keep in mind, any distribution to pay tax has a tax on that, so it becomes a pretty vicious cycle. So anyways, after the 30-year mark, the taxpayer who did not make any distribution will see their retirement account at over $700,000. The taxpayer who took out a $50,000 distribution will have the retirement account will have a value of almost $400,000, and the taxpayer that took out $65,000 will have a value of their retirement account of roughly $250,000. This assumes a 7% return on investment. So before taking out the distribution, you will certainly want to consult with your financial advisor on the impact that this will have to your retirement plan. Furthermore, there is additional flexibility in how much a individual could borrow from their retirement plan. Previously, it was 50% capped at $50,000. Has been increased to 100% capped at $100,000. This applies for loans between March 27th plus 180 days, so essentially towards the end of September. So if you know you will need to borrow some money from a retirement plan, specifically, let's say a 401k, before the end of September, you'll want to get something on your calendar so that you do not forget this cutoff date. Come October, you'll be back at the $50,000 mark. Now, this will be subject to plan limitations. So if the employer previously did not allow any loans to be taken from the retirement plan, then you will not be able to take out a loan if they do not amend their agreement. Furthermore, The employer does have 2 years to amend their plan to allow for it. Also, the loan is not available for IRAs, same as it always was. And any loan payments that are due between March 27th and December 31st are delayed by 1 year. This is for any loan payment, not just new loans, but any loan. So if a loan was taken a year ago, 2 years ago, 3 years ago, the repayment could be delayed by 1 year. During the 1 year period, interest is still accruing. Also, required minimum distributions are waived for the current year. If an individual took out the required minimum distribution within the past 60 days, they could have, or they could still roll it over back into their retirement account or into a rollover IRA. If it was before the 60-day mark, so let's say January, then as of right now, there's no provision that allows the taxpayer to put money back into the retirement account, and they're stuck with it being treated as a distribution. We are hoping for additional guidance that will provide relief for that specific situation. Another change is that 5-year stretch IRA, specifically rollover IRA, is converted to a 6-year stretch. So the 2020 distribution does not need to happen. Also, a contribution to a 2019 retirement plan has been extended. So the previous extension for certain contributions was April 15th. Has now been pushed back to July 15th. We'll talk about some tax planning opportunities around retirement planning. Firstly, there's the Savers Credit. There's a non-refundable tax credit up to 50% of the contribution. So let's say you put in $2,000 into a retirement account, up to $1,000 could be treated as a non-refundable tax credit. Now, the credit, it has caps, and the caps are as follows. So for 2020, the adjusted gross income cap is $65,000 for married filing jointly, $48,750 for head of household, and $32,500 for all other status. At these numbers, the taxpayer will get zero tax credit, but there are phase out limits before that amount. Another opportunity is a Roth conversion. With a Roth account, essentially, the taxpayer puts money into the account post-tax, and the distribution comes out tax-free. A Roth retirement account could be an ideal situation if the taxpayer believes they will be in a lower tax bracket now compared to when they start taking out distribution from the account. Specifically, this year could be an optimal year because maybe the taxpayer has less income. You know, the stock market has gone down 30%. Maybe there's less business income. There's no R&D requirements, or there's just less value in the retirement account. So all these factors could make a Roth conversion more lucrative compared to, let's say, last year. During a Roth conversion, a taxpayer will have to recognize income on the entire amount being converted. But again, when the taxpayer takes the money out of a Roth account, it's not recognized as income. Let's also talk about a potential opportunity to maximize the stimulus check. So let's look at two scenarios. Let's look at a scenario in which a taxpayer has Social Security income in which $25,000 is taxable, interest and dividends in which $40,000 is taxable, a pension in which $35,000 is taxable, and their adjusted gross income is $100,000. In 2019, the $100,000 adjusted gross income will disqualify for them from receiving any tax credit. Now let's look at 2020. The taxpayer has the same Social Security, the same interest and dividends, but they no longer have a required minimum distribution from their pension account, so they decide not to take it. Now their adjusted gross income is $65,000. Now they qualify for the $1,200 tax credit. Let's look at other tax planning opportunities for individuals. Firstly, there's an opportunity potentially to harvest capital losses with the stock market taking a dip of roughly 30%. There might be some opportunities to sell off stocks that have losses. This could potentially reduce a taxpayer's 2020 tax. By doing so, you can also keep money in your pocket by reducing your quarterly estimated tax payments. Also, if the employer plan allows for it, you might be able to revise the dependent care FSA contribution amount that's being made. I have 2 children. We were putting money aside expecting after school care and summer camp to be reimbursed by the dependent care FSA account. That most likely seems like it's no longer happening. So if your employer plans allows for it, you might want to consider that. And there might be an opportunity to file your 2019 tax return early. There could be a couple benefits out of that. The first benefit might be that if you're due a tax refund, you can put in the request now and get that money sooner than later. Secondly, if your 2018 income was above the threshold to receive the stimulus check, but your 2019 income is below the threshold, then there might be a window there where you can get your 2019 tax return filed and thereby get the IRS database updated with your numbers and hopefully be able to get the refund or the stimulus check accordingly. So we don't know what the cutoff is for them to look at your income, where you stand with your income. But we expect that to happen any day now. So we'll find out soon enough. I'll pass this off to Jennifer for closing remarks.
Thank you, Victor. As Victor and Aaron have mentioned today, the CARES Act included a lot of items for individuals, the biggest one being the extended deadlines. California has complied. A lot of other states have also complied. So we are looking to be sure there's nothing you need to do for April 15th, but be sure to reach out to your LEMI advisor if you do have any questions regarding those extended deadlines. With those being extended out, they've also extended the IRA and the Roth IRA and the HSA contribution deadlines that usually have to be made by April 15th. So that's a great opportunity for you to be able to gather those funds and make those contributions before that extended deadline. Another item that Victor already touched upon is having not to take those RMDs for 2020 creates a good planning opportunity for you if you wanted to maybe do a Roth IRA conversion, or you had some other gain or sale or something that you're looking at picking up that income in lieu of that RMD. Now, obviously, as Victor went over in depth, taking those distributions from your retirement account, there are no penalties. Please work with us. We want to work with you and your financial advisor to be sure that's the best option for you. Obviously, we know that those funds might be vital to continue anything in your personal life or your business, keep things going, but please reach out to us. But thank you so much for joining us today. We really appreciate your time. We hope you're happy and healthy. Please check out one of the other videos. If you own a business, there's a great section on businesses and those PPP loans. But thank you so much, and we look forward to working with you soon.